And if Vera Rubin is going to be in time for this year, it must be in production by now. And so today I can tell you that Vera Rubin is in full production.
The man helming the world's most valuable company announcing exactly what global investors wanted to hear. Its new platform for AI data centers, Vera Rubin, is set to hit the market later this year. We'll have all the details from CES in just a few minutes. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Nicolas Maduro and his wife plead not guilty to drug violence and weapons charges as his administration reasserts itself in Venezuela. Asian equities climbing to a new all-time high as geopolitical concerns fail to deter investors, driven by demand for technology and AI-linked stocks. And we'll get Pictet Group's outlook for markets this year, speaking exclusively with managing partner Raymond Sagayam. Asian equities are holding near record levels, with markets extending a three-year bull run driven by demand for tech and AI-related stocks. China's CSI 300 index poised for its highest close since January 2022. Investor sentiment being boosted by signs of a rebound in manufacturing activity and President Xi Jinping's upbeat assessment of the economy. Meantime, Samsung Electronics and SK Hynix also in focus after reports the two firms are looking to raise server DRAM prices by 60 to 70% in the first quarter. And Hyundai has unveiled the latest iteration of a humanoid robot designed to work in car factories. They were shown off at the CES tech gathering in Las Vegas. In fact, a lot of the big market drivers are emanating from CES. Nvidia, the world's most valuable company, unveiled a vehicle platform called Alpamayo that allows cars to reason in the real world, a product designed to speed up the development of autonomous vehicles. But the big announcement from CEO Jen-Hsun Wang was that the highly anticipated new Vera Rubin data center chips are in full production and set to be released later this year. Wang promised that customers will soon be able to try out the technology, helping speed AI development.
This is the Vera CPU. It's got 88 CPU cores, and the CPU cores are designed to be multi-threaded. But the multi-threaded nature of Vera was designed so that each one of the 176 threads could get its full performance. So it's essentially as if there's 176 cores, but only 88 physical cores. So these cores were designed in using a technology called spatial multi-threading. But the I/O performance is incredible.
Let's get the latest from what's billed as the most influential tech event in the world, with AMD CEO Lisa Su currently speaking on stage. Ray Wang, founder of Constellation Research, joins us from Ground Zero. Ray, good to have you with us. We heard from Jen-Hsun Huang, Vera Rubin. It does seem like Nvidia is doubling down on AI beyond data centers. How significant is this?
This is the next trillion-dollar market opportunity, which is physical AI. Jensen's been talking about it for quite some time. That means autonomous vehicles. That means robotics. That means other devices that are controlled and actually moved using AI and chips that reason on their own. This is the game changer that we're looking for, which is driving the $1 trillion in additional market cap that people are going to put in terms of valuations. And then, of course, the sovereign AI that's going to be powered by Vera Rubin. I think the game changer here was the fact that we didn't think it was in production yet, and they accelerated timelines. This is an announcement they normally give at their GTC event in March, not at CES. So this was a surprise to everybody who was there.
So you say it is a game changer and Vera Rubin has come earlier than anticipated. Does it change perhaps the valuations and how investors look at Nvidia right now?
I think it changes because what they're always worried about is there going to be another announcement? Is there going to be something new on the pipeline? And what they've learned over time is Jensen has a full pipe, at least for the next 3 to 5 years. Why this chip is important, it handles 1 trillion parameters. It's 5 times the performance with only 1.6x more transistors, which means it's even more efficient than what was going on with Blackwell. And of course, they're now in market and in production, which means they're driving demand for new orders as we speak.
So how is Jen-Hsun Huang positioning Nvidia right now? It's no longer just a chip company. It's now gone into autonomous vehicles. How do you view this company now?
I think it's important to think about every layer from chips all the way down to software, all the way up to devices. What NVIDIA has is an ecosystem in play. It's got all the chips that are there. It's got the software that powers the chips and the ecosystem, and it's coming across. And this is really what they mean when they're talking about full stack for the physical AI ecosystem. That means the partnership with Mercedes. That means the partnership with what's going on with Siemens. It's basically about putting AI into action. A lot of this has been theoretical, and what they've been able to show is that they've got everything across the full stack that companies and customers can take to market, and taking advantage of the exponential efficiency and infinite possibility with AI.
Ray, we know that Lisa, Lisa Su of AMD is speaking on stage right now where you are. I'm just wondering, how do the rivals compare? How does AMD compare? How does Intel compare?
Well, they're in different leagues at the moment, right? NVIDIA is dominating the GPU market, and AMD is about to launch their new GPUs to the world so that there's a competitor in the market or an alternative. And Intel, of course, is getting a lot of federal funding and a lot of funding to actually get manufacturing in the U.S. So it's kind of seen as a more state-sponsored kind of approach. All three are playing in different parts of the market and have different roles. And of course, NVIDIA's latest announcement with Grok for an acqui-hire and licensing deal gives them the ability to get into the market Google was in, which is about TPUs. So as we move from training to inference, we're moving from GPUs to TPUs. And of course, NVIDIA is working hand in hand to be able to make that happen and be able to take the efficiencies of both GPUs and TPUs with that acquisition of Grok.
As for AMD, Ray, what would you like to hear from Lisa Su that would perhaps, boost the outlook for the company?
I think on the AMD side, you're going to see a lot of opportunities to talk about more efficient chips, more availability of those chips in more applications. You're going to see a competitor on the other end in terms of ability to get production in play. And so I think it's an important piece for AMD to show that they are the alternative to NVIDIA on the GPU side, and of course, some of the partnerships that they're doing at the data center side. And so you're seeing, because of the demand in the marketplace, it isn't a winner-takes-all market yet. It's still a lot of demand and a lot of chips that are needed to power the revolution and power the commitments that have been made for data centers. We're talking almost 61 billion in data center commitments in terms of the Western world this year, and of course, more going forward.
Of course, as you said, Vera Rubin is front and center at CES. I'm just wondering whether it changes the landscape for autonomous vehicles, players like Tesla, Waymo, as well as traditional players, automakers building in-house silicon. How does it work? How does it compare? How will it go forward?
It's a great point, right? So each vehicle manufacturer has a different kind of approach. With Tesla, it's always been about cameras and camera first, using the visual approach. They've had a lot of miles, a lot of training data built into the system. What NVIDIA is saying is, here's another way to go approach this, where we actually create the training and the simulations in place to actually advance that even more quickly. And so what basically Mercedes is able to leverage is the NVIDIA technology, and then every device after that is put into use so that it can make its own autonomous decisions in its own kind of model. So it knows when to make a turn, it knows when to stop, when to avoid traffic, when to kind of consider, any kind of like hazards that are there. And so it's constantly learning, and it's in a different kind of approach than what Tesla is doing. And more importantly, it's a platform that any automaker can buy, as far as Tesla's is proprietary to Tesla.
Ray, you're sufficiently impressed by Vera Rubin. I'm just wondering, is there risk that automakers may be overly reliant on Nvidia going forward?
I think Nvidia is one of many options that we're seeing here at CES. There's a lot of other vehicle systems that are being put into play. You see other chip manufacturers that are doing this, from Qualcomm to other chip manufacturers that have their own autonomous vehicle kits that are in place. These are systems and embedded systems that are being built, that are being used to pilot not just vehicles, but also ships, also aircraft. And these are all being using similar types of models over time. So there's still a lot of room for competition in this space, but Nvidia pretty much put a stake in the ground today and said, hey, we're going to offer this to everybody, starting with Mercedes.
And speaking of competition, you have to bring in China. How are you watching? What are you watching from China's own chip ecosystems as they try to compete with Nvidia?
Well, you're seeing a lot of progress, especially with Chinese electric vehicle manufacturers. Take a BYD and a Xiaomi. They've made a lot of progress. And if you look at what's possible in terms of autonomous vehicles in China, I think they've seen much more advancement in terms of miles and training data than what we have had here on the West. And so that's definitely a place for competition. And of course, if you look at what's happening across the European landscape for vehicles, the Chinese EVs are pretty much decimating the European competition. And so it's going to be interesting to see what happens if it's just a U.S. versus China battle in autonomous vehicles going in the next 18 to 24 months.
Ray, great stuff as always. Thanks for your insight. Ray Wang, founder of Constellation Research. Well, let's get to Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. She joins us for her take on what's happening today. Victoria, I'm just wondering, how are you assessing the AI space? We've seen developments from Nvidia, for instance. Does it change, how you perceive the AI space as you look to invest your capital?
Well, I don't think it changes our outlook currently. I mean, obviously, this is an area that everyone's been watching. There's been some concerns as of late as it relates to CapEx, what that return on investment looks like in regards to debt that a lot of these companies are going into in order to do the CapEx and the deals and the circular financing. All of these elements are things that people have been worried about as of late. And I think when you hear things like you were just discussing with Ray, you hear about the Vera Rubin chips. I mean, Haslinda, I feel like it was just a couple days ago we were talking about Blackwell and how that was the newest and greatest thing. And now we have these new chips. I think it's this type of information that investors see and say, okay, we are getting some type of a return on this investment. But I do think it also takes your conversation from just looking at these hyperscalers and saying, what's the second derivative of that trade? How are these going to be put to use? What companies are going to gain the most productivity from these chips and from this AI component? That's, I think, where we'll be looking in the future as to where to invest.
So chip development coming fast and furious. We heard from Ray how, the Vera Rubin chip will change the valuation for Nvidia. Do you necessarily agree with that? Does it justify the current valuation? Are you expecting valuations to rise even further from here?
Well, we have seen valuations come down over the past few months for a lot of the hyperscaler companies, including Nvidia. Obviously, they were too high, in our opinion, they were too high earlier in this year. They have come back down. If you're continuing to have the cash flow like Nvidia has and the strength of the balance sheet like Nvidia has, then it can support that type of valuation. So will valuations go higher with this? I think we'll have to see what orders look like, what the manufacturing looks like, what costs look like. Once you get all that data, then I think you can see if valuations are should move higher and if that's going to be something that investors are willing to pay for the stock.
Are we still concerned about concentration risks? Ending 2025, we talked about how, the world's capital is pretty much focused on AI.
Yeah, I think there's concentration areas where we do need to be focused on. And when we look at earnings, when you look at the S&P for 2026, you've got earnings expectations of around 14.5%, 15%. Almost half of that in dollar terms is coming from tech. So that is a lot that we're relying on tech to really support this economy because we have to have the strong earnings in order to continue to see this market continue to go higher, to continue to have this bull market that we're in. So there's a lot of pressure on tech companies in order to perform, but we have seen a broadening out, maybe not to the scale that a lot of people have wanted to see, but that other 493, it's really started to spread out a little bit. And I think we'll continue to see more of that in 2026. So I would start looking for some of those other areas where you do have trends, upward trends for a lot of these sectors that maybe have found a trough, and that could be an area where you look to put money to work.
Within AI, though, Victoria, I'm just wondering if there are segments which are still underpriced. Are you seeing that at all, and where?
Yeah, I'm not sure if I'm seeing where they're underpriced. I do think, as I've mentioned, that the valuations have come down. So maybe they're more appropriately priced from where they were. So I don't know of too many investors that don't have allocations to a lot of these companies. But if you don't, perhaps it is a better time to go in and to start building that position than maybe where you were before at those higher valuations. But I would be cautious here. We are actually underweight a lot of these tech names. They are, as we're talking about, such a large component of the index. We're actually underweight some of those elements. And we know software is struggling right now. Semis are really kind of carrying that tech space. So we're not saying go into software when it's, not having that upward trend that we were talking about. But I do think you can maybe start watching, and when you see some names maybe bottom out and start to turn a little bit higher in other areas outside semis, then you could put that to work there.
And of course, Chinese AI and tech plays have had a fantastic run. Is it time to perhaps reassess, the value of these Chinese companies, or is still a lot of money still to be made in them?
Yeah, I think it's time to really take a look at your portfolio. Here we are at the beginning of the year. Not that just because the calendar changes that all of a sudden your portfolio has to change, but we do think that there's some risks in this market. Yes, it is a bull market. Yes, you want to be invested in the market, but there are quite a few risks out there. When we look at the U.S., when we look internationally, what are central banks doing? What does it look like in terms of the dollar versus yen versus other currencies? How is that going to shift, do we think, this year? Those are elements I think you need to start looking at and perhaps start adjusting some of your allocations. We do think international is going to be strong again this year like it was last year and outperform the U.S. So if you don't have international allocations, then I would start looking for some of those areas, but it doesn't have to be in AI or in tech. You can look in areas like financials that I think might actually perform pretty strongly this year.
And we'll talk more about those areas that you've just mentioned. Victoria Fernandez of Crossmark Global Investments. She is staying with us. Still ahead this hour, we'll have the latest developments out of Venezuela after the U.S. capture of President Nicolas Maduro, who's made his first appearance in a U.S. court. Joining us for a deep dive discussion on what's next for the oil-rich nation, as well as the wider geopolitical implications for countries like China. We'll be speaking to NYU professor Carolyn, Kissane, and SWA's Group CEO Rodrigo Villegas. Keep it here with us. This is Bloomberg. Fed officials have indicated they're likely to hold rates steady this month after 3 straight cuts to close out 2025. For more on the outlook for central banks this year, let's bring back Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, your assumptions for Fed moves this year. I'm wondering whether there could be potential mispricings between what markets are anticipating and how they're positioning and what the Fed is actually messaging.
Yeah, I think there definitely is. We saw that last year as well, right? Remember at the beginning of 2025, there were so many cuts that were priced in to the market, and we had to kind of caution our clients and say, there's too much priced in. There's going to be some repricing in the rate market and therefore in the equity market as that gets adjusted. And I think we could see a little bit of that this year, obviously not as much, because right now I think there's only a little over 2 cuts that are priced in for 2026, according to the dot plot. and what Fed futures are looking, I do think the market, though, actually might anticipate 3 cuts this year. Investors are kind of looking at that as to have 3 cuts. I'm not sure we get that. I think they're on hold for January. There's just too much uncertainty still, even though I know this Friday we get the first full month of our non-farm labor report. I do think that there's just going to be too much push and pull between their 2 mandates in order to go ahead and do a cut at the January meeting. I think that's what most people are anticipating as a hold, so you probably won't see a repricing here. But as we have a lot of stimulus coming in the first couple months, Haslinda, of the year, in regards to the one big beautiful bill that has a lot of tax cuts for corporations and for individuals, there's going to be stimulus coming in, and I think that's going to make it harder for the Fed to cut as they go into meetings later in the year.
So where do you see the most value in fixed income? How would you be playing this space?
Yeah, we definitely think there's going to be a steepening of the yield curve, and not necessarily because we think inflation is going a lot higher, and so the longer end of the curve is going to go up. We do think it will go up, but probably just the term premium that's there, in regards to what liquidity looks like, continuing to have issues around debt and the deficit in the United States. But the short end of the curve, we do think it'll come down slightly. Like we said, there's about 2 cuts priced into the market right now. So you get that short end of the curve coming down, and you get a little bit higher on the long end, so you get that steepening of the curve. We like positioning in the short end to take advantage of yields coming down, and we would wait for that longer end to go higher and then buy further out the yield curve. Lock in some income that you can have for the next 5, 7, 10 years, and just let those cash flows occur. So we would do what we call kind of a barbell strategy, the short end of the curve and the long end of the curve, in order to take advantage of that.
Victoria, is there a sense that there is too much complacency in the market? When you take a look at what happened over the weekend, the events in Venezuela, investors pretty much shrugged off concerns and risks. How are you viewing, the risk appetite and perhaps complacency in the market? It's been going on for quite some time now.
It really has, and complacency is a great word to describe it. So we come in to 2026 with extremely high valuations. We've got, the historical percentile. When you look at some of the valuations, whether it's forward PE or price to free cash flow, those are all like 95th percentile historically. So really high levels here. And you have to say, what is going to be the upside surprise that can help move this market forward, that's going to continue to be supportive of the bull market that we're in? And I think investors think it's just going to continue, and they're ignoring some of the warning signs, some of the elements of a weaker labor market, some of the things in regards to earnings expectations. Are they going to continue to stay high? Profit margins are at all-time highs. Can that continue when you have a low-income consumer that actually is pulling back? Is that going to continue? I think we have to watch those elements and know that there are risks in this market and not be quite so complacent. I would position my portfolio with a little bit of defensive posture in order to be well positioned, because it is a midterm election year, and you tend to have some consolidations around the middle of the year, and we want to be prepared for that.
Victoria, great insights. Victoria Fernandez of Crossmark Global Investments. Thank you so much for joining us. We leave you with the U.S. futures. This is how it's shaping up for the U.S. markets. It is indicating a positive open for the U.S. Still to come, Venezuela's Nicolas Maduro declares himself innocent of U.S. narco-terrorism charges in his first court appearance. Details next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight Here's a quick look at where markets stand as mainland China heads to lunch and Japanese traders return from their break. Of course, we heard from Morgan Stanley saying this is poised to be a strong year for risk assets, and perhaps we're seeing that right now. The CSI 300 index is up by about 1%. The Hang Seng also continues to surge ahead, higher by 1.7%. Of course, we've heard the story of tech and AI that's driving the markets pretty much in Asia. Now, in geopolitics, Venezuela's government has sworn in Delcy Rodriguez as acting president after the U.S. captured Nicolas Maduro. Rodriguez saying she would work with Washington to make Venezuela great again. Meanwhile, Maduro faced a U.S. court along with his wife, pleading not guilty to narco-terrorism charges. Their appearance sets off an extraordinary legal battle with major political ramifications. Bloomberg's Miles Miller reports from New York.
Venezuelan President Nicolas Maduro pleaded not guilty Monday in federal court in New York to charges that could keep him behind bars for the rest of his life. When he walked into the courtroom, he wished people Happy New Year, and at one point, someone screamed at him, and he had a loud outburst saying he was kidnapped. He and his wife sat wearing headphones and jail garb to listen to translation as Judge Alvin Hallerstein read the charges against him. When asked to enter a plea, Maduro said through an interpreter, "I am innocent, I am not guilty, I am a decent man, I am president of my country." There are 4 counts against him, including narco-terrorism conspiracy, cocaine importation conspiracy, and weapons charges. His wife faces 3 counts. If convicted, he's looking at life in prison. Starting in 2000, he allegedly moved loads under protection of Venezuelan law enforcement and became foreign minister in 2006, starting to sell diplomatic passports to traffickers. When they needed to move money back from Mexico, prosecutors said he arranged for government planes to fly under diplomatic cover, meaning that no one was checking what was on board. The indictment says he and his wife ran armed guard escorts to protect cocaine shipments. They maintain state-sponsored gangs, prosecutors say, to facilitate the operation. And when people didn't pay or threatened the business, they ordered kidnappings, beatings, and murders. And this is a massive scale. By 2020, the State Department estimated 200 to 250 tons of cocaine per year were moving through Venezuela. Also charged is their son, Venezuela's interior minister, and a gang leader. Maduro represented by Barry Pollock, the same lawyer who represented Julian Assange. The judge in this case ordered Maduro and his wife held without bail. Trial won't happen until 2027. They'll return to court on March 17th. At the courthouse in Lower Manhattan, I'm Miles Miller, Bloomberg News.
Let's get insights on the situation in Venezuela with our panel of experts. Carolyn Kissane is a clinical professor at the New York University School of Professional Studies. Also joining us is Rodrigo Villegas, founder and CEO of SUAS Group, a strategic intelligence and communications firm. Rodrigo, let's start with you. How are you assessing the stability in Venezuela? How stable is the country, is the government under Rodriguez?
Thank you for having me, Haslinda. Well, I think Venezuela is entering, is re-entering the geopolitical space right now, and as it's re-enter this new space of political participation, amidst these geopolitical tensions after ousting President Nicolas Maduro, I think this will be a phase of political transitioning. I think the stabilizing Venezuela, it's a priority right now. Although most of the Chavista and the Maduro regime still is in place, I think moving forward we'll see some challenges, especially under President now, Delcy Rodriguez, although she's been proved to be very pragmatic in terms of handling the political atmosphere and also dealing with some of the alliances around the world that she has been able to ink into several accords. So I think right now the pressure is on President Rodriguez, Delcy Rodriguez, but also on how is she being able to handle the most rough or tough part of the Maduro regime, such as Diosdado Cabello and Vladimiro Padrino Lopez. I think that those factions of the Maduro regime are tougher not to crack right now, and she has to gain unity among that regime in order to accomplish the significant political steps that have to be done in order to keep stability and governability around the next few months.
Do you see Rodriguez being able to balance the tightrope? I mean, key to all of this is meeting the expectations of the U.S.
I think she has two major challenges. One of them is keeping the social and political establishment at peace, right? She has to navigate those political hallways of power under several other factions in the Maduro regime, and that will be a major challenge. However, the other major challenge will be how to appease the U.S. requirements. But I think under those circumstances, dealing with the U.S. requirements will be easier for her in order to accomplish what the U.S. wants, which is try to open Venezuela up, re-entering a new geopolitical era under new investment, new economic opportunities. And I think that she has proven to be quite a good operator on those arenas. She has handled quite well, I think, under these circumstances, the oil industry in Venezuela. And she has the capability to figure out how to stabilize and move forward in economic terms. However, the political stance and the political circumstances in Venezuela are much more tougher to navigate, because at the end of the day, as any other regime, there are several factions that are opposed to the U.S. intervention. So I think it will be a challenge, but she has proven to be quite pragmatic. And let's not forget that there is also his brother, Jorge Rodriguez, that he's presiding the National Assembly, and that will be also an operational tool that will be very beneficial for her political operation.
Carolyn, needless to say, the rest of the world is watching closely, especially China. I'm wondering if China might capitalize on the situation, perhaps use it as a chance to accelerate its own rise.
Well, thank you, Haslinda, and thank you so much for having me. I think the question is an excellent one. I think in terms of oil, we will continue to see the Venezuelan exports, about 800,000 barrels a day that goes to China. I think this idea of a kind of a new template for sort of spheres of influence amongst global powers. And so I do think that this is a kind of an invitation for China to be sort of bolder in its own sphere of influence and its neighborhood, specifically with regards to Taiwan. So this is definitely something to watch closely.
What message do you think China might be wanting to send to its allies, or the allies of the U.S. for that matter?
The message that it wants to send to its allies, I think China is also going to take a very sort of cautious approach. They came out clearly in opposition to what the United States did in terms of capturing Maduro and sort of seeing it as questioning the legality of it, breaking international law. So I do think that they will use this opportunity to sort of gain favor amongst allies, potentially new allies. It is really important to note that China is the sort of largest trade partner with many countries across Latin America. There will be countries that will sort of see China maybe more so than the United States right now as a safer partner. So I think things are unfolding very, very quickly, but this is I think an opportunity for sort of China to sort of gain some advantage, especially with countries that are sort of fearful and, very sort of questioning in terms of the motivations of the United States and what the United States might do next.
It could have been a message that this is a U.S. that is in decline. And back to Venezuela, Rodrigo, we've been talking about the possibility of elections. Realistically, what kind of timeline should we be looking at for a free and fair election?
Well, I think, Haslinda, it's very premature to think about election right now. I think, it's been a few days since the ousting and capture of President Maduro. So I think the priority right now for the Trump administration is to stabilize the country, prevent any chaos and any political upheaval. And I think for the elections to be held, there must be some steps that have to be taken into account. Stabilizing politically and socially, have the economy quite in a tight ship, so to speak, and also to figure out how to gain the unity among the regime. I think there's a long way to go before elections. People saying that 180 days before elections, I don't think that's accurate. I think that this will be a long-term process in which, of course, everyone wants a democratic process. But I think it's super premature to determine how fast can free elections can be held. I think before that there were significant challenges to be seen, especially preventing social unrest and political unrest. And let's see how President Rodriguez navigates such political and social challenges before any further steps. I think also the national security apparatus of the United States has to plan before a transition into a democratic elections. It has to be a two-way kind of a dance before election can be held. There has to be planning. There has to be significant circumstances in which the elections can be guaranteed to be free, can be democratic, right, and be safe.
So still lots of challenges, but if and when elections happen, what would it take for it to be viewed as being legitimate by both Venezuelans and the international community?
Well, I think the President Trump's administration's strategy going into Venezuela, at least from public statements and from my hearing out of Washington, is that there has to be some kind of roadmap before a national and international consensus is made, right? There has to be some circumstances in which the opposition in Venezuela and the regime, the rest of the regime, move forward into a democratic process. This doesn't guarantee that the regime will disappear or the significant factions that support President Maduro, even socially, the baseline of the electorate, moves away. That will remain. There's a significant portion of the population that supports Maduro and the regime, and there's another portion that doesn't. But I think that building consensus, building a real dialogue in terms of political future has to be made and has to be accomplished before an election is implemented. The recognition part, I think, is that once that the regime has been acknowledged as a no future kind of gain, I think that's when the opposition can make its case, and the regime will have no option but to go into an election, right, and to take into account different actors in Venezuelan politics.
Carolyn, it is quite clear that President Trump has upended the world order. Do you think China has managed to perhaps, found a new world order, an alternative world order? It's always tapped the global governance institutions likes of BRICS, even AIIB. How successful has it been in trying to build this new alternative world order?
So again, I think that China's view of the world and the United States view of the world, I mean, they at one point looked very different. I think with what we've seen recently and sort of Trump's sort of more interventionist approach, the way that he's sort of looking at, I think he's brought in this idea of sort of great power politics, spheres of influence, which I think also is something that sort of China, as you said, has been advancing for, since Xi Jinping came into power, with the Belt and Road Initiative. Again, I do think that this sort of further validates sort of China's sort of position in terms of its view of the world, in terms of looking at, opportunities that it is going to see, and that, again, China has had a very relatively good relationship with Venezuela. It was really sort of Venezuela's bank for many years. I think there's a big question mark as to sort of what China's role will be in Venezuela moving forward. But again, as what I said earlier, I do see that this is that China will take this as an opportunity to gain advantage, to gain new allies potentially, and to, again, I think it's its view of they considered sort of Taiwan to be part of China, and I think that it's that they will see this as a kind of an opportunity under the Trump administration.
And obviously, it's a big concern for smaller states in particular. How do you see smaller states responding, and how should they respond, you think?
I think smaller states are really nervous right now. I mean, we just saw last night in terms of some of the statements that, Trump made about, wanting Greenland. He even mentioned Mexico, Colombia. I think, small states will be looking to sort of how they're going to sort of protect themselves in light of, allies and alliances. I think they're also going to be sort of staying rather quiet. I think there is some concern that Trump might take some. The Trump administration might take some action in Colombia, specifically against the drug cartels. This, I think one of the things that we're hearing from Trump is that, this is a kind of an emboldened moment, feeling that he had success in terms of capturing Maduro. So at least in terms of some of the rhetoric and some of, not even just the rhetoric, but even going to the national security strategy of 2025, I think some of the smaller states in South America, I think are probably meeting and discussing, approaches in terms of how they manage this particular time. But I think I would also say that small states writ large are feeling a lot of concern, and so will be something to watch carefully.
Carolyn, Kissane, New York University School of Professional Studies, and Rodrigo Villegas of SUAS Group. We thank you so much for joining us today. Plenty more ahead. Keep it here with us. This is Bloomberg. Let's do a check on Indian markets, which have been trading for about 5 minutes. It is looking negative for the Sensex, scrolling down by 0.3%. The Nifty index also in negative territory. In terms of the Indian rupee, it's trading at 90.1150. It is higher by about 0.2% versus the USD. And we know that India's IT stocks in particular ripe for a rebound as traders unwind bearish bets, seeing an improving earnings outlook and moderating valuation. Let's bring in our Asia equities editor, Chiranjeevi Chakravorty. CJ, what's driving that opinion there?
Hi, Has. Thanks for having me. At this point of time, it seems like beaten down valuations and prospects of earnings growth recovering from what has been a nadir in 2025, where growth was about 2% year on year, analysts are now expecting that growth to slightly improve as the US economic outlook holds up quite steady. And at the same time, client spending, many of the client of IT companies which are based out of Europe and US, they are indicating that they are willing to spend a little bit more heading into 2026.
There are already signs of a recovery. I'm just wondering how much more upside and what are the risks to that projection?
Yes, I mean, last quarter, which is the fourth quarter of 2025, IT stocks actually outperformed the Nifty benchmark index. That is despite a very wretched year. And analysts are hoping that this gain or momentum can continue into the first quarter of 2026. We are seeing bearish positions in some of the bigger names in the space, such as Tata Consultancy or Infosys, being cut down quite rapidly by speculators. And the hope is, the risk actually going forward is again the AI trade. This sector was underperforming because of its lack of exposure to artificial intelligence. And as we have seen across Asia, with the AI trade gaining momentum in the beginning of the year, that will continue to be a big risk for valuations when it comes to Indian IT companies.
It begs the question whether it is all enough in the end to attract foreign investors who made an exit in 2025.
Yeah, I mean, at this point of time, that is the big question. Foreign investors did exit in 2025, but at this point of time, it also seems like a lot of these investors are looking for diversification. We know that there have been questions raised about valuations in the AI space, in the North Asia tech trade, for example, and therefore, some of the diversifiers that are available in global markets right now, such as Indian IT companies, where earnings improvement is quite visible, could end up benefiting from such a rotation.
CJ, thank you. Bloomberg Asia Equities Editor Chiranjeevi Chakraborty. And now here are some more top corporate stories we are following. BlueScope Steel shares surging in Sydney after Steel Dynamics, an Australian conglomerate, SGH, made a joint $8.8 billion takeover bid. Sydney-based SGH, controlled by billionaire Kerry Stokes, proposes acquiring Australia's biggest steelmaker and then selling its North American assets to Steel Dynamics. BlueScope has long been seen as a takeover target, as its North American operations account for almost half of its revenue. Tesla's China factory shipments fell 7% in 2025, despite a last-minute bump in December. Preliminary data from China's Passenger Car Association show the automaker shipped over 851,000 vehicles last year from its Shanghai plant. Tesla is struggling with a slowdown in global sales, losing its title as the world's largest EV maker to China's BYD. And Walt Disney says Zootopia 2 has become the highest-grossing Hollywood film ever released in China when measured in local currency. The sequel has earned about $610 million since it was released in late November, surpassing 2019's Avengers Endgame. Our report estimates animated movies generated nearly half of last year's China's box office revenue, with 57 titles grossing over $3.5 billion. Still ahead, we assess the investment landscape as 2026 begins with a global stock rally. Pictet Group Managing Partner Raymond Sagayam will be joining us exclusively in just a moment. Plus, the outlook for Indian IPOs with JPMorgan. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian stocks climbing to a new record as geopolitical concerns fail to deter investors. This marks the fourth consecutive day of the advances for the MXAP, which is also seeing its best start to a year since 2012. Chinese equities, meantime, extending their rally to a 4-year high amid AI-driven gains and signs of an economic recovery. Materials and technology shares among the day's best performers in Shenzhen and Shanghai. Let's get to our executive editor for Asia Markets, Paul Dobson, joins us now. Paul, no stopping this rally. It keeps going higher.
Yeah, hi, good morning, Haslinda. That's exactly right. Good afternoon, in fact, just over the midday hump. And markets still looking pretty rosy. I guess there's a couple of things that you can think about when you're looking at the markets, because what we've seen is actual outperformance in Asia at the start of this new year relative to the rest of the world. And I think that tells you something about where investors are looking to put their money right now. The start of a new year, people look at their asset allocations, they look for where they think are going to be the hot spots. And I think that emerging markets and Asian emerging markets are places where people are keen to put their money to work at the moment. So we've seen some pretty big gains led by the largest companies on the index across South Korea, across Japan, across the rest of the region as well in these recent sessions, kind of driving equities higher. I think that, that talks to the idea that rather than looking at the US, where, the market has outrun the rest of the world for a number of years until last year, people are looking to put their money around the rest of the world a little bit more. And so the inflows are coming from outside the region as well as from within the region.
That's right. What U.S. exceptionalism, right, Paul? I mean, on the back of that, China outperforming best performance in 4 years, you got to wonder whether that kind of gains are sustainable.
Yeah, definitely, because the economy is still not looking all of that robust, right? It's the same clouds that have been hanging over China for a good long time now. What they really would like to do is get that consumer confidence flowing a little bit more, have more money moving around the system. But nonetheless, what investors really like is the AI story in China. All of these new companies or companies we hadn't necessarily heard that much about before, all bubbling up to the surface, really having momentum. The idea that China is kind of a little bit like where the US was 3 or 4 years ago and still playing catch up, and the valuations so much lower than those that we see for the US markets gives people another reason to be interested in those Chinese names. And the government, by the way, has the back to a certain extent pushing its agenda for sort of, new industrialization and high technology companies, not just in AI space, but right across sort of all different manufacturing parts of the industry.
We know that precious metals have also done well. What's the case for it in the next 12 months?
Great question. What was the case for it in the last 12 months is something that, people still don't absolutely have a very firm handle on. But what we do know is it's a supply and demand thing as much as anything else. Central banks have been accumulating more and more gold, looking to add silver as well. And so that's one thing that's been taking supply out of the market when there hasn't been a huge amount of new supply coming in. And people are jumping on the bandwagon, right? Physically, you want to have that precious metal. Now, if you're planning for your weddings, you're planning for your festivities down the road, if you know that the price is continuing to rise, get in there. We've seen a lot of retail hunger for it. But I think there's more than that as well. And particularly for silver, there's the industrial applications. And, that has really been driving the prices higher as well. On top of that, the whole of the metals complex sort of has this other thing, this nagging doubt that the Trump administration is going to put higher tariffs on imports of metals at some point, and so that's sucking demand into the United States as well. And so one more reason why the whole of the metals complex is getting that continuing uplift that we've seen at the start of this year.
Paul, great stuff. Our executive editor for Asia Markets, Paul Dobson there. Let's get more insights. Joining us exclusively, Raymond Sagayam, Managing Partner at Pictet Group and Co-CEO of Pictet Asset Management. It is one of Europe's largest privately owned financial institutions, managing around $926 billion in assets as of last September. Well, good to have you with us, Raymond.
Thank you, Haslinda.
So we heard from Paul, there seems to be a lot of euphoria. Equities are up, precious metals are up, never mind what happened in Venezuela. Is that too much optimism? Is that too much complacency? How are you viewing the market right now?
I think if the up sign next to those markets is a reflection of diversification away from U.S. exposure, that's a healthy sign, and it reflects a continuation of a theme which I believe we're in the early innings of, which started last year, i.e. that U.S. exceptionalism has peaked and is starting to unwind. If you think about the US as an example, it still represents 64% of global stock exposure, yet only 25% of global output. That is a very big disconnect. And that is only corrected by 2% over the course of last year, largely as a function of what Paul already described, rallying markets outside the US, which have overtaken the US. I believe that is set to continue, and it is set to continue driven by a desire to de-USify exposure, which is perhaps disproportionately large in US assets. Both
So
bonds and
North
equities.
Asian markets like China, like Korea, like Japan will continue to do well. Emerging markets will continue to do well. They were outperformers last year, and they've had a great run the beginning of this year too.
I don't think there's any reason to believe that those are isolated, one-year-off performances. The thesis for emerging markets is, in my view, stronger than ever. There are so many reasons for it. Valuations alone, which have been cheap for a long time, are not just a catalyst, but they're there. Despite the rally, valuations are very interesting, particularly in emerging market equities. If you look at emerging market debt, these are economies where inflation is well under control. Average local interest rates are 5.5%. We believe there's room to cut a further 1.5%, which provides capital upside. Growth differentials are only increasing relative to developed markets. And of course, many of these economies, the ones you described, Haslinda, are beneficiaries of the AI value chain as well. The list is very long, it's growing, and it's hugely stacked in favor of both emerging market debt and equity.
And it's also about monetary policy, that divergent path between the Fed and the central banks in this part of the world.
Yes, but interestingly enough, even though we are having an economic divergence, some of those monetary policy metrics are starting to converge. For example, 85% of central banks globally are looking to ease and to cut. Brazil, South Africa, many frontier markets. Of course, the Fed is potentially cutting, but arguably for different reasons. In emerging markets, they're cutting for fundamentally sound reasons, because inflation is under control and they can and should cut. Whether the Fed should continue to cut is a very debatable point.
What is the one macro risk that you're keeping an eye on that perhaps investors are mispricing or not paying enough attention to?
That's a good question. I can think of two, but if you really channel me
Go with two.
Okay, we'll start with one, interest rates. I really believe that U.S. interest rates, particularly term interest rates, are very perfectly priced. Let's put it that way. Depending on the Fed chair choice in May of this year, all that will do is influence the front end of the interest rate curve in the U.S., whether that's a dove or not. What the Fed will be less in control of is term interest rates. And for me, that has profound implications on the broader economy. If we think about CapEx spending with the AI hyperscalers, they've started to shift towards debt financing. And as a result of that, they're going to be more vulnerable to term interest rates, not just policy rates. Those term interest rates are a function of the classic supply and demand. And if more and more agents worldwide are looking to de-USify, right, both bonds and equities, surely that also potentially has implications for US Treasuries. And as a result, I potentially see a risk of yields breaking much higher. And of course, if they move too quickly, that can be very destabilizing for a stock market, which is now looking to be well poised and well positioned.
How much higher for those yields? How high might they go?
That's difficult to predict. It's more about the velocity of that move and whether we break potentially 5% on the 10-year, which of course is a long way away from right now. I identify it as a tail risk and as a risk in answer to your question, which I believe is underappreciated right now, because that is something which can be less controlled by the Fed. Of course, there are twists and things which they can do on the yield curve, but ultimately that is driven by global appetite for US assets, not just risky assets, a perception of safe assets, and that remains a big question mark for me.
You talk about how we're looking at a de-USification.
Yes,
if there is such a word for it.
I just made that word up, but you know what I mean.
But bearing in mind what you have just said, are we then looking perhaps of a de-dollarization as well? Does one come with the other necessarily?
That's a great question, because if you look at how last year played out, we had a 10% downward move in the dollar, but unscathed in US assets. Not only unscathed, actually a rally of 17% in dollar terms in the S&P, and of course Treasury yields continuing to squeeze even lower as well. So you had a dichotomy and a divergence rather between the dollar move and asset class moves. What happens if this theme of diversifying away from the US. Let's frame it in positive terms, actually embracing other unloved markets like emerging market equities, like European stocks and so on and so forth. Let's assume that continues. Now, of course, that has profound implications for a continuation of the dollar decline. But can we imagine that the dollar continues to decline without affecting the price and valuation of US assets, both stocks and bonds? That's something I'm wrestling with, and I find hard to believe that it can be sustained, and I believe is one of the bigger risks in the markets. The fact that a dollar move and a continuing dollar decline can actually start to reflect and drag US asset valuation down as people start to sell and diversify away. And we didn't see that last year, Haslinda.
If you were to hazard a guess on how the dollar would move this year, what would be the catalyst that you're looking out for?
There are several catalysts. The most recent one is what occurred in Venezuela in the past few days. Now, on the one hand, I believe that many who are jumping to the conclusion of drawing parallels with Maduro, China and Taiwan, Russia and Ukraine, those are quite stretched. Maduro, I think many would agree, is globally recognized as potentially not the best actor. And I don't think those parallels with Taiwan and Ukraine as targets are relevant in any shape and form. What I found a little bit more concerning is the rhetoric, the narrative which followed after the event. This talk of the Donroe Accord, which is an enhanced version of the Monroe Accord in 1823, effectively the US telling Europe to butt out of US affairs. Now, if that is a reflection of increasing geopolitical fragmentation, imperialism, and a desire to control the Western Hemisphere, already there's been chatter about Greenland, Cuba, Mexico, and so on and so forth. And now, if that continues, how can we imagine a world of asset allocators who are comfortable with that disproportionate allocation in US assets? Of course, they'll maintain exposure, but the same level? Potentially not. And this is where I see that trend continuing and the de-USification starting to broaden beyond just the dollar.
Do you see investment opportunities in that?
Great opportunities. This is why I don't want to frame it negatively. The US is always going to play a huge and central role in investment portfolios. But come back to the earlier point about 64%. Is that the right number? Think about European equities. I think European equities remain extremely cheap. They're trading at a 30% discount to the US. The fiscal taboo has been completely obliterated, not just broken, not just in Germany, but the rest of Europe. That spend alone is going to lift European growth, trend growth, from 1.1 to 1.5%. It may not sound like a lot, Haslinda, but it is a lot for trend growth. And that, of course, means a significant re-rating in stocks. We've just talked about the stock market in Asia and other emerging markets. I think there are wonderful opportunities in both emerging market equities and bonds, European and other developed markets away from the US, and potentially even in private assets, but maybe with a tilt towards European markets.
I want to talk about the business, your business, as a result of what happened in Venezuela and what happened to Maduro. The Swiss government has frozen his assets and the assets of people close to him. I'm just wondering whether there's been any implications, any impact on Pictet or any of the other wealth managers in Switzerland.
No, there isn't a direct consequence of that, but it's important in this kind of environment of geopolitical fragmentation that we have a long-term perspective, right? We have been private for 220 years, and that's allowed us to see beyond the trees. When you look at the market reaction to Venezuela, as you said, Haslinda, there was euphoria. Everything was up, plus, greens everywhere. But if you think about the medium-term consequences, right, what does that mean with regards to regional blocks, economic blocks continuing to solidify and isolate from each other, and then the implications on markets? So I believe that we are very well positioned in Switzerland with our neutrality to make those objective and very long-term and very neutral decisions about asset allocation in that regard.
And is Switzerland still well positioned to be the leading financial hub? It's seen a lot of headwinds of late, including tighter security, tighter regulatory environment. Do you see Switzerland still holding that position?
I do, and I think we are in an enviable position because of our geographic position, because of our neutrality, And as I say, because of how we're structured, if I think about the Pictet group and how we are constructed and we are structured as a private organization, we're not trying to determine the short-term trends or fads. We're trying to look long-term to the benefit of our clients. That's what we've done for 220 years, and that's what we're going to continue doing for the next 220.
And what's the plan for the next 12, 24 months? Are you hiring more, given the opportunities you see, especially in this part of the world?
I think the business outlook is interesting, it's bright, but it has to pivot and it has to evolve with the evolving geopolitical and economic world that we're in.
What does that translate
What
to
does that
for
mean?
Pictet?
It means Asia continues to be a very, very strong focus of ours. In the past, it was servicing Europeans looking for Asian exposure. Now it's increasingly servicing our Asian wealth and asset management clients who are looking for global exposure. If I think about other megatrends which I think are shaping our business, cybersecurity, this was the other risk, by the way, which I didn't mention earlier. Something which I think is underappreciated and underestimated, but which we take extremely seriously. Already many crypto exchanges have been breached. This is a theme which I think is going to continue and could represent another tail risk. And this is also how we need to orientate our business to the benefit of clients. There are many dimensions, instant finance, whether we think about tokenization, active ETFs, and the impact of geopolitical fragmentation on asset allocation. These are top of our mind right now in how we service our clients.
Is the strong Swiss franc top of your mind? How is that impacting business and profitability? How are you managing that?
The strong Swiss franc is always on our mind and on the mind especially of our local Swiss investors, because they find increasingly challenges in finding global opportunities once you swap it back into Swiss francs. We believe we're well positioned with
What
the
are you doing about
recommendations.
it? How are you managing it?
Agility in a multi-asset portfolio, offering a suite of private assets beyond the usual with a very strong European tilt, alternative investments, particularly hedge fund investments, which are providing higher octane, uncorrelated returns, swapping well into Swiss francs. These are some examples. And of course, let's not forget where we started in the first place, Haslinda, emerging markets. It is different this time. There are many reasons why it's different.
We've had that before. It is different this time. Raymond?
It is, but you've heard it here.
Thank you so much for your time today.
Thank
Raymond
you,
Sagayam, Managing Partner at Pictet Group. Still ahead, selfies and smiles at the second meeting in 2 months for the leaders of China and South Korea. More on the push to reset relations amid a range of geopolitical challenges. Keep it here with us. This is Bloomberg.
China is ready to work with South Korea to stay firmly committed to friendly cooperation, uphold the principle of mutual benefit and win-win outcomes, and push forward the development of the China-South Korea Strategic Cooperative Partnership on a healthy trajectory, so as to promote the well-being of the two peoples and inject positive energy into regional and even global peace and development.
It's only been 2 months, but I have that feeling that I'm meeting an old friend I haven't seen for a long time. It's quite cordial and heartwarming. For thousands of years, South Korea and China, as friendly neighbours, have forged friendly relations. I am ready to follow the trend of the times and work together with President Xi to usher in a new chapter in the development of South Korea and China ties.
The Chinese and South Korean presidents speaking during their meeting on Monday. For more, let's bring in our China correspondent, Min Lo, in Hong Kong. And Min, the tone was pretty obvious from both leaders, pretty warm, pretty friendly. Were there concrete outcomes from the meeting as well?
Yeah, it's pretty substantial. The two sides had signed at least 14 MOUs covering many different sectors. And I think one key concern for President Lee Jae-myung is to correct that trade deficit. The trade surplus that South Korea has with China has turned into a deficit in 2023. And the concern is that it could become entrenched as China ramps up its own domestic advanced manufacturing. And it's been increasingly difficult for South Korean companies to compete in China. So he brought with him a delegation of about 200 business leaders. The head of SK Group, the head of Hyundai, Samsung also was there. And he was asking to expand trade and increase collaboration, especially in areas like AI, consumer goods, cultural goods as well. And we know, for example, that China has placed this informal ban on South Korean entertainment in China since the THAAD missile crisis in 2016. And the South Korean presidential aide has said that it could take a while for China to lift that ban, but they are hopeful that as trust is being rebuilt sometime later in the longer term future, we could potentially see K-pop concerts resuming in China once again.
Perhaps not that soon, though, right? I mean, this meeting coming amid a backdrop fraught with geopolitical tensions. How is that shaping China-Korea relations?
Yeah, I mean, we are seeing so much uncertainty in the world right now. In the sort of neighborhood of South Korea, there is the China-Japan tension that is flaring up with Takaichi's comments. So we'll have to see how South Korea balances that, because the South Korean President Lee Jae-myung is going or is expected to meet with the Japanese Prime Minister Takaichi sometime in January as well. China will definitely be watching that very closely. Already we see in this trip, President Xi pressuring South Korea to, quote, stand on the right side of history. And we saw South Korea also reassuring China that they will continue to respect the one China principle. So there is that pressure coming out of this trip in exchange for some of the economic concessions that we saw, because one key breakthrough I forgot to mention is that the two sides finally agreed to resume a ministerial level economic dialogue that has been frozen since the THAAD missile crisis. So that's one key development. Of course, there is the North Korea issue as well. North Korea fired what was believed to be ballistic missiles just ahead of this trip as well. And it came after President Trump seized Maduro, and the message it's sending to North Korea, some analysts say, is that it can't afford to abandon the nuclear program. It could be equivalent to suicide. So South Korea has asked for Beijing's help to advance peace in the Korean peninsula, but that task could be even more difficult now as North Korea ramps up on its nuclear program.
Min, thank you so much for that. And of course, we talked about the selfie that the two presidents took and was used, the Xiaomi phone that was gifted by President Xi Jinping to his counterpart. Min, thank you so much for that.
That's right.
Bloomberg's China correspondent, Min Lo. Let's do a check on how Asian benchmarks are shaping up. We know that Asian stocks are at a new record highs. Investors pretty much shrugging off developments in Latin America. Now, still to come. Will India's IPO boom hit a new record high in 2026? We'll get the outlook with JPMorgan's head of India Equity Capital Markets, Abhinav Bharti. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand right now. Take a look at the Asian markets as a whole. They are at new record highs. Nikkei 225, the Topix Kospi all in positive territory. The Nikkei 225 up by about 1%. The Kospi higher by 0.6%. We know that North Asian markets have been lifted by tech as well as AI plays. Taipei, the TWSC currently up by about 1% as well. We're keeping an eye on the Sensex. It is in negative territory, down about 1%, and the Indian rupee, though, is higher by about 0.2% versus the USD. The Nifty index now trying to inch towards the green as we speak. Now, Asia's equity capital markets expected to deliver another standout year in 2026. Long dormant IPO plans are coming back to life, with significant listings anticipated from Chinese tech firms such as Baidu and Zepto. Let's bring in our Asia ECM reporter, Dave Sebastian. And Dave, it does seem like Asia's IPO market building on 2025.
Indeed, it was a very busy year last year. We're just off a 4-year high in proceeds from share sales across the region. And it seems that we're off to a busy start this year. Just In January alone in Hong Kong, we're seeing at least 11 listings raise $4 billion just this month alone. It's set to be among the busiest starts of the year on record in several years for Hong Kong. And then there's also India fueling a chunk of large deals in the region. And then, like there's also Malaysia and Singapore and South Korea and Japan. So there's really not a shortage of deals for bankers to work on this year.
How big will these IPOs be? What can be anticipated from markets like China and Hong Kong and India?
Yeah, it's quite a mixed bag in terms of the pipeline, but let's start with Hong Kong first. We've got these deals that have been shelved for some time coming back to life, including those of Watson, which had been in the works since at least 2013, and then there's also Syngenta Group, the Chinese agri-tech company, Chinese-owned firm that's set to list in Hong Kong after previously considering Shanghai. And then on top of that, you've also got the Chinese AI firms that are coming to market, including the ones that are listing this week, which are Minimax and Chapu. And then down the road, there's also Baidu's AI chip unit, which is set to list in Hong Kong. So there's really a big pipeline here. And then for India, there's also Geo, which is set to be India's, it's the top IPO on record for the nation on record.
It is interesting, Dave, that we're also seeing a lot of multinational companies IPOing in India.
Indeed, yeah, that's among the bread and butter as well for India. My colleagues have written about the potential IPO of Coca-Cola's bottling unit there and also some others. So that's also going to be part of the pipeline. And then there's also a number of new age companies like Zepto, the quick commerce firm, for example, that's going to fuel the India pipeline. So that's going to be really, quite a busy year as well down there.
Dave, thank you. Bloomberg Asia ECM reporter Dave Sebastian. Now, Asia's equity capital markets are shaping up for another blockbuster year in 2026, building on the surge that put the region at the forefront of global share sales. JPMorgan, meanwhile, has reclaimed the top spot in India's equity offerings for the first time in 5 years. It's claimed a market share above 11% after handling deals last year worth 537 billion rupees. Joining us now is JPMorgan's head of India equity capital markets, Abhinav Bharti. Abhinav, good to have you with us. Talk to us about your own expectations of the IPO market in India. How upbeat are you?
Hi, Haslinda. No, I think, I think the prognosis going into this year, certainly, I would say the setup for the market is much better this year at the start of 2026 versus where we were at the start of 2025. So that's starting point number one. Just the place where the secondary markets today in India are, I would say the backdrop in terms of the expected performance and the tailwinds that we expect for India this year are better versus where we were 12 months ago. In that backdrop and the fact that as a sub-asset class of the market, IPOs have done pretty well, especially when you look at large-sized IPOs, which I would describe as anything above, call it $300 million in size or capital raised. That set of IPOs have actually delivered decent returns to investors. I would argue that going into 2026 and forward, you are starting to see that regular trend where India could, like I mentioned earlier, potentially raise about $20 billion every year on an ongoing basis in just IPOs going forward.
It is interesting to see that Indian companies IPOing in the market are not really using the funds to expand or to invest in their own companies. How do you view that pattern, that theme of what they're doing?
So one of the aspects which is unique about India is that there is a significant focus on companies coming to the market having already delivered or achieved a certain level of profitability. What that implies is that the requirement for capital to be raised from public markets actually goes down because most of those companies by the time they're coming to IPOs have already started delivering cash flows or are at a reasonable level of profitability. So that is actually a very unique part. Unlike, let's say, in the US, where we have seen very early stage companies being able to tap market, Indian markets have generally preferred to see slightly more maturity for companies going public. What that has implied is that in order to, deliver a decent sized IPO, you would essentially have a reasonable component of secondary sell downs coming in from initial shareholders. So it's a phase of the maturity that is driving the amount of primary being raised at IPOs, rather than companies not wanting to raise capital by design or by choice.
In terms of offer pricing, I'm wondering if local money managers are more influential than the foreign ones at this stage.
Yes, indeed, without a doubt. I think the big story in India for the last 5 to 7 years has been the development of domestic capital base. And if you really look at the numbers for last year, $90 billion was invested by domestic institutional investors. That's separate from retail investors that participated in the market. And really, if you look at it compared to 2024, which was the previous high for the market, that number was 63. But if you really unpack the numbers, of that 63, the mutual funds, which is where a significant part of the volume on the domestic capital is coming, were about, call it about 52 billion, and the non-mutual fund domestic institutional capital was 11. Last year, that 52 went to 57, but the 11 grew to 33. In other words, you're starting to see what I call it as the second order, benefits of equity capital or deployment in the equity market starting to happen from domestic capital base. You're seeing insurance companies, pension funds, and other parts of the domestic ecosystem now starting to gain size and quality that they are able to deploy significant sums of capital in the capital markets. In other words, there are just multiple avenues for issuers to raise capital now just from the domestic market.
When it comes to ECM deals in India and foreign participation, do you think their participation has been pretty much influenced and shaped by geopolitical risks, or are there other factors in play?
So I would say geopolitical risk is something that we go through every year. It's been part and parcel of capital markets for the last 10 odd years. So nothing different. Yes, some years more than usual. Certainly the part which has affected the Indian markets from a foreign sentiment or foreign investor sentiment perspective last year has been the entire AI trade. India is seen as not a market which is currently a beneficiary of the AI trade. And therefore, to that extent, a lot of money has, I would argue, kind of flown out of India to deploy into markets in this part of the world, which are seen as AI winners, likes of Taiwan, Korea, etc., which have obviously done very well in 2025. Having said that, look, how long does that trade work? How long it continues to perform? I would argue India is therefore an AI defensive market, and that's going to be one of the key things that market participants are focused on, how it gets played out this year. Any weakness on the AI trade, you may see India to be one of the markets where investors come back to in order to find returns.
Right. Apart from AI, are there other investment themes, perhaps even sectors, which will drive and dominate equity issuances in 2026?
So technology or broader TMT, if I may say so, put it as one sector, is going to be, in my view, the largest place where capital will get raised. And it's not just consumer tech, but you will see tech services, communication services, each of those sectors coming to the market and raising a reasonable amount of capital. Apart from that, the other part, which of course on the cross-border thematic has been very relevant, has been the consumer space. That's where a number of global corporates have significant presence in India, and to that extent, we expect that market or that segment to remain active. Apart from that, the other sectors like renewables, utilities, you will see sporadic capital raises, but I would argue TMT and consumer to be the two most active sectors going into this year.
Abhinav, we know that investors are spoilt for choice. For institutional investors, they're getting more selective. Do you see issuers actually adjusting to that, I guess, new environment?
It is. I mean, if you look at the discussion on valuations around the IPOs in particular, it is taking into fact how investor sentiment has behaved. And I would argue that the pricing discipline, especially when it comes to the IPO markets in India in the second half of last year, was fairly robust, with investors making sure that they were making their voices heard to managements and issuers, keeping that in mind while pricing these issues. The key aspect, or one of the big reasons why I expect the IPOs to continue doing well, is because that sub-asset class has delivered, call it about 15 to 17% return in the last 1 year, in a year when the markets were, I would say, broadly flattish for the year. And that allows for investors to also come back and evaluate new issuances this year.
What advice would you give issuers wanting to tap the equity market in 2026?
I think the key word in my view this year is going to be timing the market windows. I certainly expect this year to be more volatile, so to speak, not so much driven by the local sentiments, but more by global factors and global events that may take place. The risks certainly are rising on that front. When, from an equity capital markets perspective, it is less correlated to the level of the market, but rather more correlated to the volatility on a day-to-day basis. So to that extent, it is about finding the right windows to raise capital is going to become the most important aspect when it comes to issuers being able to tap market. For an IPO where you are effectively taking at least a 2-week risk, it becomes even more pertinent.
Of course, there are other markets which are attractive to investors when it comes to IPOs. Hong Kong, a case in point. How does India compare, and how does India become more competitive than the other markets for IPOs?
So with respect to, I think the type of capital which is obviously investing in the two markets, I would still say has very little overlap. Leaving aside even the domestic capital, which is quite relevant both for India and for Hong Kong, China markets, which are the key drivers in each of these respective markets. But even from an emerging market pool, I would argue that there is still very little overlap between the capital that is heading into China versus India. There is some overlap, but not a lot to really make a difference. At this stage, I don't think there is a competitive aspect wherein one market doing better means that you're pulling capital out from the other. But at least for the next foreseeable few months or years, I don't see that to be an issue between either of the markets. The emerging market pool continues to remain quite deep enough to support activity in either markets.
Abhinav, we're seeing emerging markets doing really well at the end of 2025, and that has persisted through the start of the year. Is this the year that India will see the return of foreign investors in its own market?
Well, that's certainly the expectation, because one of the key numbers or data points that we keep track of, and if you look at historical trend lines when foreign investors have invested in the market and invested big, has been the relative premium of India versus the emerging markets. Historically, that number, whenever it has been between, call it 50 to 70%, we have seen robust inflows from foreign investors into the capital markets. By the end of 2024, start of 2025, a year prior, that number had actually peaked up to about 90%, so it was looking quite punchy. As things stand today, with all the performance that the emerging markets have seen in the last 1 year and India underperforming quite significantly, that relative premium is actually down back to about 65%. So like I said, on a relative basis, India seems much better positioned and poised this year for foreign investors to come back. The AI trade, like I mentioned earlier, is something that one needs to see, but at least the setup on a valuation perspective certainly looks much better for India this year.
There are several concerns for investors when it comes to investing in India. One, the weak rupee, and two, the trade negotiation between the US and India to do with the tariffs. How are you assessing, both factors?
So the tariff and the trade negotiations is an important sentiment part. I don't think it has an immediate major delta or changes to how investors look at it, because we've now seen about 5 months that 50% tariffs have been applicable, And so far, the high frequency data coming out on the export number seems to be that exports have held up quite well. So to that extent, I would argue that at least it's more a sentiment part or driving factor rather than on ground anything specific changing from a trade perspective. Yes, in the medium to long term, any trade deal will actually be quite strongly positive because the amount of changes that are happening in India is just generally becoming more competitive economy when it comes into the global context. And the moment that playing field becomes more level versus other countries, you would find that we could actually do even better than what the Indian trade numbers are currently showing up as.
So 2026 is poised to be India's year then, Abhinav?
Certainly, as things stand today, I'm looking forward for a much better start to the year versus where we were last year. And the lineup for companies. The other part, also to keep in mind is that the quality of companies that we are starting to see to come to the market has also been quite good. There are various different business models that are coming to the market. It's allowing more diversification for investors. The governance levels that we are seeing with these companies and the focus on them, especially when it comes to global corporates looking to list their Indian subsidiaries, the governance levels are quite high. So all of these aspects are a big positive in terms of the development of the Indian capital markets becoming more and more open and readily available for global capital to be deployed.
Abhinav, thank you. Abhinav Bharti, head of India Equity Capital Markets at JPMorgan. Now, former U.S. Commerce Secretary Wilbur Ross says President Trump faces a long and complex task as he attempts to reshape Venezuela's economy and global energy markets. Our exclusive interview is coming up next. Keep it here with us. This is Bloomberg. Let's do a check on oil prices. Looking pretty steady right now after the biggest gain in a week as traders weigh the outlook for Venezuela amid concerns about a global glut. Now, the surplus is expected to expand in the first half and reach its peak mid-year, and that's according to Morgan Stanley. Brent crude currently down about 0.2%. Now, former U.S. Commerce Secretary Wilbur Ross says China and Russia have benefited by getting cheap Venezuelan oil. He told us exclusively that President Trump's vision for a U.S.-led revival of Venezuela's oil industry will be a long, complex, and costly undertaking.
Well, there's a lot that needs to be done. In terms of laws, Venezuela has the weakest property rights laws in the whole world. So that has to be fixed so that you have some assurance of private sector continuing ownership. But I think realistically, companies going in now in a relatively complex situation are probably going to want guarantees against expropriation. And that's not unusual. The U.S. and multinational entities often give expatriation and foreign exchange guarantees. Now, the debt structure is mind-bogglingly complicated. They have about 160 billion of debt altogether, counting expatriation claims, counting funded debt, counting debt for oil, counting everything. Those bonds have been trading in the high teens, low 20s. They could probably be restructured in the 30 to 40 cents on the dollar. So in the overall context, that's not a very big number. And one of the few good things is that the IMF has no exposure to Venezuela. And IMF is entitled to lend up to $50 billion. So they could very well be a source of some funding.
If I can just jump in on that point before we continue, Wilbur, because some of the exposure we do understand comes from China and debt owed to Chinese banks, for example. If there is a restructuring of debt in the country, do you expect the U.S. to exert force of who gets priority in the capital stack? Does it change where back payments and different restructuring comes from, just given the geopolitics of the moment between the U.S. and China?
Right. Well, both the Chinese and the Russians had made loans to Venezuela that are payable at least partly in oil, but oil at very, very advantageous prices to them. So they are part of the problem in that they're getting oil very cheaply out of Venezuela in return for debts that otherwise are never going to be paid. Now, the oil that comes out of Venezuela is mostly what we call heavy oil, and that requires a slightly different refining process from the American shale oil, which is mostly light oil. Both China and India have very strong facilities for processing heavy oil, because a lot of the Iranian oil that they had been getting also is heavy.
And that was from a U.S. Commerce Secretary Wilbur Ross speaking to Bloomberg's Danny Berger. Now, Venezuela, notwithstanding, Asian stocks continue to rally, hitting yet another record high. Investors keen to have more attractive valuations, looking for strong growth prospects in this part of the world. The MSCI Asia-Pac Index currently up by more than 1%. The Hong Kong-listed Chinese tech shares jumping to the strongest level since November. The benchmark index in Shanghai headed for its highest close since 2015. Before we go, here's a look at our guests for tomorrow. Pepper Stone joins us to dig into market sentiment as Asian equities extend record highs. Keep it here with us. This is Bloomberg.